Emerging market. An emerging market, or an emerging country or an emerging economy, is a market that has some characteristics of a developed market, but does not fully meet its standards. This includes markets that may become developed markets in the future or were in the past. The term frontier market is used for developing countries with smaller, riskier, or more illiquid capital markets than emerging. The economies of China and India are considered to be the largest emerging markets. According to The Economist, many people find the term outdated, but no new term has gained traction. Emerging market hedge fund capital reached a record new level in the first quarter of 2011 of $121 billion. The 9 largest emerging and developing economies by either nominal or PPP-adjusted GDP are the BRIC countries, Brazil, Russia, India and China, along with Indonesia, South Korea, Mexico, Saudi Arabia, and Turkey. Terminology. In the 1970s, less developed countries, LDCs, was the common term for markets that were less developed, by objective or subjective measures, than the developed countries such as the United States, Japan, and those in Western Europe. These markets were supposed to provide greater potential for profit but also more risk from various factors like patent infringement. This term was replaced by emerging market. The term is misleading in that there is no guarantee that a country will move from less developed to more developed. Although that is the general trend in the world, countries can also move from more developed to less developed. Originally coined in 1981 by then World Bank economist Antoine van Atmael, the term is sometimes loosely used as a replacement for emerging economies, but really signifies a business phenomenon that is not fully described or constrained by such. These countries are considered to be in a transitional phase between developing and developed status. Examples of emerging markets include many countries in Africa, most countries in Eastern Europe, some countries of Latin America, some countries in the Middle East, Russia and some countries in Southeast Asia. Emphasizing the fluid nature of the category, political scientist Ian Bremmer defines an emerging market as a country where politics matters at least as much as economics to the markets. The research on emerging markets is diffused within management literature. While researchers such as George Haley, Vladimir Kvint, Anando de Soto, Usha Haley, and several professors from Harvard Business School and Yale School of Management have described activity in countries such as India and China. How a market emerges is little understood. In 2009, Dr. Kvint published this definition: an emerging market country is a society transitioning from a dictatorship to a free market-oriented economy, with increasing economic freedom, gradual integration with the global marketplace and with other members of the GEM, global emerging market, an expanding middle class, improving standards of living, social stability and tolerance, as well as an increase in cooperation with multilateral institutions. In 2008 Emerging Economy Report, the Center for Knowledge Societies defines emerging economies as those regions of the world that are experiencing rapid informationalization under conditions of limited or partial industrialization. It appears that emerging markets lie at the intersection of non-traditional user behavior, the rise of new user groups and community adoption of products and services, and innovations in product technologies and platforms. More critical scholars have also studied key emerging markets like Mexico and Turkey. Thomas Mawar, 2012, 2, argues that financial imperatives have become much more significant and has developed the idea of emerging finance capitalism, an era wherein the collective interests of financial capital principally shape the logical options and choices of government and state elites over and above those of labor and popular classes. Julian Vercueil recently proposed an pragmatic definition of the emerging economies, as distinguished from emerging markets coined by an approach heavily influenced by financial criteria. According to his definition, an emerging economy displays the following characteristics. At the beginning of the 2010s, more than 50 countries, representing 60% of the world's population and 45% of its GDP, matched these criteria. 10 among them, the BRICS. The term rapidly developing economies is being used to denote emerging markets such as the United Arab Emirates, Chile and Malaysia that are undergoing rapid growth. In recent years, new terms have emerged to describe the largest developing countries such as BRIC, Brazil, Russia, India, and China, along with BRIC plus Eastern Europe and Turkey, BRICS, BRIC plus South Africa, BRIC plus Mexico, Mexico, Indonesia, Nigeria and Turkey, next 11, Bangladesh, Egypt, Indonesia, Iran, Mexico, Nigeria, Pakistan, the Philippines, South Korea, Turkey, and Vietnam, and civets, Colombia, Indonesia, Vietnam, Egypt, Turkey and South Africa. These countries do not share any common agenda, but some experts believe that they are enjoying an increasing role in the world economy and on political platforms. Lists of emerging, or developed, markets vary. Guides may be found in such investment information sources as Economist, a Euromoney institutional investor company, The Economist, or market index makers, such as MSCI. In an Opal-esque.tv video, hedge fund manager Jonathan Binder discusses the current and future relevance of the term emerging markets in the financial world. Binder says that in the future investors will not necessarily think of the traditional classifications of G10, or G7, versus emerging markets. Instead, people should look at the world as countries that are fiscally responsible and countries that are not. Whether that country is in Europe or in South America should make no difference, making the traditional blocks of categorization irrelevant. Geegan et al. 2014, also discussed the relevance of the terminology emerging country comparing the creditworthiness of so-called emerging countries to so-called developed countries. According to their analysis, depending on the criteria used, the term may not always be appropriate. The 10 big emerging markets, BEM, economies are, alphabetically ordered, Argentina, Brazil, China, India, Indonesia, Mexico, Poland, South Africa, South Korea, and Turkey. Egypt, Iran, Nigeria, Pakistan, Russia, Saudi Arabia, Taiwan, and Thailand are other major emerging markets. Newly industrialized countries are emerging markets whose economies have not yet reached developed status but have, in a macroeconomic sense, outpaced their developing counterparts. Individual investors can invest in emerging markets by buying into emerging markets or global funds. If they want to pick single stocks or make their own bets, they can do it either through ADRs, American Depository Receipts, stocks of foreign companies that trade on US stock exchanges, or through exchange-traded funds. Exchange-traded funds or ETFs hold basket of stocks. The exchange-traded funds can be focused on a particular country, for example, China, India, or region, for example, Asia-Pacific, Latin America. Commonly listed. Various sources list countries as emerging economies as indicated by the table below. A few countries appear in every list: BRICS, Mexico, Turkey. Indonesia and Turkey are categorized with Mexico and Nigeria as part of the mint economies. While there are no commonly agreed upon parameters on which the countries can be classified as emerging economies, several firms have developed detailed methodologies to identify the top performing emerging economies every year. BBVA Research. In November 2010, BBVA Research introduced a new economic concept to identify key emerging markets. This classification is divided into two sets of developing economies. As of March 2014, the groupings are as follows. Eagles, emerging and growth leading economies, expected incremental GDP in the next 10 years to be larger than the average of the G7 economies, excluding the US. Nest, expected incremental GDP in the next decade to be lower than the average of the G6 economies, G7 excluding the US, but higher than Italy's. Other emerging markets. Emerging Market Bond Index Global. The Emerging Market Bond Index Global, IMBI Global, by JP Morgan was the first comprehensive M-sovereign index in the market, after the IMBI Plus. It provides full coverage of the M asset class with representative countries, investable instruments, sovereign and quasi-sovereign, and transparent rules. The IMB Global includes only USD-denominated emerging markets sovereign bonds and uses a traditional, market capitalization weighted method for country allocation. As of March end 2016, the IMB Global's market capitalization was $692.3 billion. For country inclusion, a country's GNI per capita must be below the index income ceiling, IIC, for 3 consecutive years to be eligible for inclusion to the IMB Global. JP Morgan defines the index income ceiling, IIC, as the GNI per capita level that is adjusted every year by the growth rate of the world GNI per capita, Atlas method, current US dollar, provided by the World Bank annually. An existing country may be considered for removal from the index if its GNI per capita is above the index income ceiling, IIC, for 3 consecutive years, as well as the country's long-term foreign currency sovereign credit rating. The available ratings from all 3 agencies, S&P, Moody's and Fitch, is A/A3/A, inclusive, or above for 3 consecutive years. J.P. Morgan has introduced what is called an index income ceiling, IIC, defined as the income level that is adjusted every year by the growth rate of the world GNI per capita, provided by the World Bank as GNI per capita, Atlas method, current US dollar, annually. Once a country has GNI per capita below or above the IC level for 3 consecutive years, the country eligibility will be determined. Emerging Markets Index. The Emerging Markets Index by MasterCard is a list of the top 65 cities in emerging markets. The following countries had cities featured on the list, as of 2008. Countries with cities included in the Emerging Markets Index 2008 by continent/region. Global Growth Generators. Global Growth Generators, or 3G, countries, is an alternative classification determined by Citigroup analysts as being countries with the most promising growth prospects for 2010 to 2050. These consist of Indonesia, Egypt, 7 other emerging countries, and 2 countries not previously listed before, specifically Iraq and Mongolia. There has been disagreement about the reclassification of these countries, among others, for the purpose of acronym creation, as was seen with the BRICS. Estimating demand in emerging markets. Estimating the demand for products or services in emerging markets and developing economies can be complex and challenging for managers. These countries have unique commercial environments and may be limited in terms of reliable data, market research firms, and trained interviewers. Consumers in some of these countries may consider surveys an invasion of privacy. Survey respondents may try to please researchers by telling them what they want to hear rather than providing honest answers to their questions. However, some companies have dedicated their entire business units for understanding the dynamics of emerging markets owing to their peculiarity. Economy. The following table lists the 25 largest emerging economies by GDP, nominal, and GDP, PPP, in their respective peak year. Members of the G20 major economies are in bold.